Thank you very much. My name is Neko Kekari, Deputy Director, Enterprise Development Center, Pan-African University. So we work with entrepreneurs in Nigeria, and so far we've trained over 2,500 entrepreneurs. The last comment Wendy made, and Sam, it's something that actually made me come for this. There's been so much talk about impact investment, and in the last couple of years, there's so much talk and we can't see much happening. But I'd like to start the conversation and take that conversation further concerning the pipeline. So you have a lot of entrepreneurs that don't even know what impact investment is, and that's actually what they're doing. They see that they can access these funds, but they're not ready. There are very few organizations that are working with entrepreneurs. So my question or suggestion is there a way we could look at working with organizations and centers that are working with entrepreneurs to actually prepare them and not just leave them? Because what happens is that they are actually in that social space, but along the line, by the time you don't look at them and the commercial bank or a PA looks at them, there's so much that is lost for that space. So is there something that we could do? So it could be, would it be investing or funding those organizations? How about mentoring? That's also a very big component, especially in my country, Nigeria. You're talking about electricity. For most entrepreneurs, they spend almost 40–50% of their capital on electricity. So first and foremost, they're already uncompetitive, which is why the Chinese market is growing every day in my country.
Okay, why don't we take a round? Sure. And that way it's going to be, there's a lot of energy in the room. We want to maximize on that.
Morning, my name is Anne Lithukushoma. I'm a social entrepreneur myself. And I'm here because of that very issue of pipeline. I worked on the impact investment side, rather the philanthropy side of the United Nations for a long time. And then I tested what it looks like on the social entrepreneurship side. And what I've learned, even as a person who has access, unlike many young social entrepreneurs and entrepreneurs with whom I work, is that there is actually no conversation that's going on really. I have attended several incubation programs really just to test what they have. And what I've found is that there's almost little useful advice that can take an entrepreneur from their idea to an impact investment or to any kind of investment. And so the very people who are managing social incubators have no experience in actually gaining investment itself. And so you are sitting there with a great conversation. I mean, I was listening to Nicholas speaking and I'm thinking, oh my goodness, it would be great for you to be sitting there having conversations about exactly how Yellowwoods does business with all these young entrepreneurs whom I know are interested in your very industry. But they have absolutely no clue what you're talking about. They would have no clue what you're talking about. So the conversation is completely different. So we need to find a way to invest very, very seriously in the incubation that takes place. And Wendy, thanks. I think the incubation idea is a very, very powerful one. I attended one in the US called the Unreasonable Institute, which I thought was the most powerful incubation program that I've seen, and that I think we should consider for Africa. The Unreasonable Institute brings together mentors for 6 weeks with entrepreneurs, and they walk you through detail and exactly what you need to do, and bring investors as well. And so that's the kind of training I think that we need. So we need to up it, and there are many, many, many young entrepreneurs whom I've come across who just don't have the opportunity and the linkages. Thanks.
And I would like to ask each of you how you incorporate social impact into your cost of capital. So it is about investors being able to invest and taking on more risk, but we are investors and we are rational beings. And so we take risk commensurate with the reward we're looking for. So being able to understand how impact looks, how it actually rewards us as investors, I think is very important. And I'd love to hear if you guys have concrete ways that you're doing that.
Go ahead.
My name is Mark Van Olst from Spinnaker, Group Growth Partners. We essentially a finance first investment fund, but I want to put a different thought into the room in terms of this either-or discussion around impact and finance first. The reason we're at a conference like this is we believe that there's funds that we'll manage that will set our pipeline up for our classic finance first investments later. So we look at, particularly in the supply development networks, there's fantastic companies there. They're not startups, they've been going for a long time. They can't come to us for our classic commercial finance first investments yet. They're not ready. They don't understand what they need. So we work with them with a big dose of business development services first, also with some capital because they need that too. And then we hope to at least harvest 10 or 20% of those guys into the pure capital stuff. So they can also sit next to each other, the classic impact investing space and then the finance first. So just want to put that thought out.
And the questions I think were around incubation and support to entrepreneurs and ideas around how we engage with that. Some specific questions around how you factor in social impact into thinking about returns and cost of capital. And finally, looking at sometimes your socially or impact motivated pipeline can lead to purely financial opportunities down the road, and you can think of it almost as an earlier stage level of engagement. So any responses in the panel on each of those? Wendy, you've been going last each time. Why don't we start with you this time?
Where do I begin? Let me say this on the preparation of entrepreneurs. Well, firstly, let me start here. Over the next 10 years, there will be 1.2 billion young people who are going to come into the workplace. And out of those numbers, only 300,000 of them will get a job somewhere. So we have 900 million people in the world who are going to be doing what? Walking around, loitering, I'm not quite sure. So we have a responsibility to take that into account. And I mentioned this, perhaps it's irrelevant to what we're discussing, but it actually isn't irrelevant. I'm mentioning this because I want to suggest that we need to change our mindset about where young people are going to be engaged when they complete their education. It's not going to be in a job. It's going to be in something else. And that something else has to be in entrepreneurship. So if as a global economy or as a regional economy or as a local economy, we're going to have to prepare large numbers of entrepreneurs, and I was actually encouraged to hear from the dean of the school that they are lobbying for entrepreneurship as a degree, and that's going to be free, because that's really what we need. We need those kinds of revolutionary solutions that are going to prepare large numbers of young people, or whatever age, if you feel inspired to become an entrepreneur, but large numbers of people who have the tools to take their ideas to the market and actually create successful businesses with their ideas, because that doesn't exist. And whether that's incubation or whether that requires a degree in entrepreneurship, and it probably requires a whole combination of things, including mentorship, a whole range of things that are going to, but as a continent, as the global economy, we actually need to think of that as a vision, that, or as a plan of action, or whatever you want to call it. The second thing that I think we need to consider is the whole idea of risk capital. And really for this, we can learn a lot from Israel. They have such a different approach to entrepreneurship. It's such a small nation. If you blink, you probably would miss it in the map of the world. But if you look at what they have contributed to the global economy in terms of their innovation and in terms of their ideas, it really is a function of their relationship with risk. We are totally risk averse in most parts of the world. The banks are risk averse. The banks don't understand the DNA of entrepreneurs. So we need to change our relationship to risk, and really, because as we change that, we then begin to think about risk capital completely differently. Because when we remove all of these elements, when we think that an investment is a risk, then we kind of limit the potential of what's possible. So it's really it's our mindsets that I think need to be what's the word I'm looking for? They need to change. I was looking for a more stronger word. Transformed, reformed, or whatever the case might be. It's not that there's a lack of capital or there are lack of ideas. It's us. We stand in the way of really leveraging what's already available. There's enough in this continent to make this economy of this continent, the greatest and the most successful economy in the world. But we stand in the way of that because we have very traditional ways of thinking about what needs to be done, how the solutions should be created.
Thanks. I think Wendy's made the risk point so eloquently, so I'll make a different one. About the incubation ideas, I mean, just a thought on that. I mean, we work a lot with youth economic inclusion and grapple a lot with the question of, well, two problems that I think talk to Wendy's issue. I mean, the one is that the truth is it's quite difficult to be a successful entrepreneur if you've never had a job. Not everybody, I mean, entrepreneurs are a small subset of human beings, and it's even that subset of human beings, it's very hard to run a business if you don't have the social networks, the economic networks, and the experience that comes with working in the economy. And I'm making that point not because I want to dwell on the youth, the questions you're raising about how we get young people included in the economy going forward, but I think this issue of market connection is as important in the incubation process as skills. And I think that there tends to be an over-focus on this idea that what we need to do is educate people to be good business people, as opposed to connect them to opportunity and work on the demand side and work on the market access and opportunity and openness, which is what I talk about as inclusive economy. And that, I mean, the challenge of that, which I think is critical, I mean, the most exciting, I mean, and you talk about an exciting incubator, the most exciting incubator I've ever seen is in Silicon Valley. But most of what it does is networking. It doesn't do skills. It creates networking opportunities for people with ideas to reach markets and connect with people who can be markets. So I'm only mentioning that because I think that when we think about those solutions, the challenge for us where we have such differentiated and such extremely unequal economies is that it's very hard for people to connect into the economy or between parts of the economy in a lot of African countries. If you're in the elite and you're not in the elite, those are two different planets as opposed to two different neighborhoods next door each other. Right? So, and I just think when we think incubation, we need to think about market connections, and that requires something that I think business is generally quite bad at, which is partnership and collaboration. And I think this is something, and the social sector is also quite bad at it actually. And I think that we mustn't underestimate that in the investor space, understanding that the opportunity of this next phase is going to come through a new business discipline, which is partnership and collaboration, and being able to unlock things that have to come together, that didn't used to come together or sit together. We say government's not in the room, and that's indicative. We don't know how to make these partnerships work. We don't know how to make social sector and business partnerships work, and that's actually what's often needed to unlock these investment opportunities. You need the patient capital and the investment capital to come together. How does that happen? How do you align those interests? Now, I'm not saying I've got answers, but I think that when we think incubation models, we have to be thinking through some of those questions.
Okay.
Go ahead, Sam.
Okay, I'll just hop on the incubation one and I'll try and answer the question on the cost of capital. Apart from the point that Nicola made, I think there is an important point, which is the model that we are trying to run at the Tony Elumelu Foundation. Just to make a distinction, Hess Holdings and the Tony Elumelu Foundation are two separate organizations. They do impact investment, we do commercial investments. But one of the models we've been thinking of, because I also have responsibilities for managing the impact investment portfolio for the foundation, is exactly what the gentleman mentioned earlier on. It's become clear to us that even if you're going to have incubators, they have to be investor-led incubators. I know what I want in a deal, right? I know sometimes when guys come and they get a teaser or some IM or whatever, or an investment opportunity, there are times I tell my team, and we look at it and say, if only this guy did this way or structured it that way, it would make it a whole lot better. And we advise them sometimes. But I'm not structured to actually provide that support. But I know exactly what I need to see in a deal that would catalyze my capital. So I think the problems we have is the incubators we have not, they are not investors. So they don't come from that perspective of understanding exactly what the investors want. And Nicola made a very good point. They're not even looking at it from the perspective of connecting these businesses to the investors. They're more like, helping them with certain skills, which is helpful, by the way. So I think the model they have, that the gentleman mentioned that they have, is the kind of model we are moving towards. Create your own pipeline. If you really want to do this impact investing in Africa and make a difference, you really have to create your own pipeline. You could look for those businesses that are really not there, and you may have set up a separate structure to handle that bit, or maybe we can collaborate together as impact investors to have some kind of structure to have that bit. But it has to be driven, in my view, by the investor, because they will help put those business in a shape and form that would attract significant capital. Even if they don't do it all, they create the opportunity for other people to do it. You wanted to make a point, right. But let me finish the other point. So you asked a very good question on and I'll take it as pricing an impact investment deal. Now, when we started, and our impact investment associate this year, we had this big challenge, right? So I was trained as a banker. So I come from a traditional background of pricing a deal, which is what is the risk and what is the kind of return I should be getting for this risk I'm taking, given the cost of capital that I have. And so we initially had this problem of pricing. How do we get the right price? Because if I look some of the deals that come to us, when we look at them with pricing, it is not sometimes if it's an equity investment, it will wipe out you're basically telling the guy you can't do it. And if it's some form of debt structure or whatever, he's better off going to some kind. It just didn't work when we look at it from a pure risk and return point of view. So what we tried to do was we said, but this guy has additional value that he's bringing apart from this financial return. He's bringing a social return, which we have to find a way of measuring and quantifying. So what we did was, and it's not perfect, but we use it, right? And it's early to say whether it works for us, but it helps us, because I have in the foundation we have a very tough investment committee made up of very tough guys and very nice philanthropic guys. And oftentimes when you pitch a deal to the investment committee, you have to, the philanthropic guys, like the whole social story around it. But the top guys are asking, you're going to burn my money if we put this in. So what we did was, we found a way of quantifying the social impact. So we in writing the investment memo, we actually capture the social return that we expect from this investment. It may be in terms of jobs that are created, it may be in terms of some other form. And we try to, in a kind of a scientific fashion, try to assign a return in quantifiable terms to that social return, and then we now use that to discount the return we expect on. So if I price the deal on the commercial basis, I say this deal I should be getting 24% return, and we are able to assign something to the social aspect and say, well, the social return should give me over the next 3 years maybe 14%. We use that 14%, we take it off the social return and say, from a commercial point of view, we are happy if we are only getting a 10% return from this deal, because we know that it would create this level of social return. That's what we do in the impact investing portfolio. So that's the way we approach it in our organization. But it's a real problem, and it's one that I think if we can fix, makes it easy to unlock even additional capital to come into this space.
Some follow-up questions were coming up, two in the front row. I think there was this young lady and Demi and the gentleman over here.
So just to follow up on what you said about the M&E that you've improvised, I'm just concerned that the word impact investing is becoming a new buzzword that people will latch onto to create perception for themselves in the world and who they are. And are we differentiating between impact, outcome, and output? Because if your return on investment, if your primary return is going to be financial, any business, if we really looked hard and researched, would have some sort of social impact. And then just bringing it back to Emme's slide about the spectrum, and where do you cross out somebody from being an impact investor to just being an outcomes investor? And how do we create policies to guard against those things?
I just wanted to second the comment that Sam made about putting the onus more on the investor community to help actually drive the success of an investment. And I don't think this is just for impact investment. I think in general, particularly around Africa, I mean, those funds or families, et cetera, that have been the most successful are those that actually kind of internalize the problems they see their entrepreneurs or the businesses they're supporting, and try and take that forward themselves. And I don't think that's a function of just being social or being particularly impactful. It's just a question of wanting to win and wanting to sort of help your entrepreneurs win. And I think this also goes back to the commentary earlier about who bears the burden of impact. And I think it's actually the investor who should really try and tell that story, alongside their entrepreneurs. Otherwise, you may be putting too much of a burden on them, because it's hard enough to make a business succeed, in Africa in particular, let alone trying to sort of play a different tune to different types of investors. So I just wanted to add that.
Hey James, as you continue to get the feedback, let me ask, when people do speak, it's good to know the perspective from which you're coming from. So this is a quick, introduction of your name and some sort of affiliation, just so we sort of know where your perspective is coming from.
Sure, Demi, as you know, I'm an investor, in most cases, sometimes an entrepreneur, and I invest in East and West Africa.
Thank you. My name is Sheila Gastro. I come from an organization called Inyatelo, the South African Institute for Advancement, and we work mainly with non-profit sector and universities on their financial sustainability. There are two things that I just want to raise here. The one is this issue of incubation. We run what we call a non-profit clinic. Non-profits come to us, they're looking for resources, and we believe in a mixed model. It's not only donor dependent, but about 15% of the organizations or people that come to us are people who want to start organizations that have a social impact. And not many of them actually want to be donor dependent. Many of them want to start up some kind of business that will have the social impact. And unfortunately, they start like that, and a couple of years later they'll come back and ask, how do they restructure to become a non-profit? They cannot find that investment. There is no place that I know of in South Africa where they can go and pitch their ideas. So it's just a big gap. And secondly, while we're talking about entrepreneurship, and I can only talk about South Africa, we can train entrepreneurs, we can provide the networks, but in fact we have hundreds of thousands of people from other African countries here who set up their own informal trading. They come from Senegal, they come from Somalia, they can turn a shop out of a matchbox. And we do not use those people to train South Africans in how to set up businesses. In fact, we kind of see them as invaders from the north and are highly aggravated by people coming here doing very much what our own people should be doing. And I think somebody has to think out of the box at how do we build that incredible resource into entrepreneurship development in South Africa.
My name is Gary Graham. I'm the founder of an entity called Future Fit, and we work in the business of helping impact entrepreneurs increase the impact and their reach in the work that they do. I want to start off quickly with a confession. I'm normally bored at events like this, mainly for one reason, and that's because of the self-stroking that normally happens. And when the self-stroking is finished, we sort of get into some mutual stroking. And I'm making that confession because I really want to comment on this thought, Nicola, the lack of collaboration. I work in a sector where we don't believe there's a lack of ideas or lack of energy amongst entrepreneurs. Neither is there a lack of capital. But often entrepreneurs really struggle with, how do I get access to that? We see incredible levels of collaboration between entrepreneurs themselves, starting second, third, and fourth enterprises. What we really suck at as a sector is the level of collaboration between the organizations supporting those entrepreneurs. Now, in this room, we've got some great entities. We've got Impact Amplified on there. We see Tiba's tweets going out. And so the questions from the audience around, what are the mechanisms for supporting those entrepreneurs? There are great organizations doing that. But somehow we haven't really got this ecosystem thing nailed down. And you watch the tweets going out here. Wendy says, listen, we need to educate entrepreneurs, and somebody, bangs out a tweet and it goes out to 1,000 people. That's what we do, that's what we do. Because we have the sense, this scarcity thinking around, even with organizations supporting entrepreneurs, that, we've got to vie for our little slice of the cake. So I think my challenge is not just to the investment community, but even to those organizations supporting entrepreneurs. We really need to look in the mirror and say, what is it that we're doing to drive collaboration more effectively? And really, I'm not interested in anything that you do. Then when you get up and you tell me where you studied and what you do, that bores the hell out of me. What really turns me on and what really juices me is when you tell me why you do what you do. And I think that's my challenge to particularly organizations supporting entrepreneurs across the country, the continent. Why is it that you do what you do? We have a significant role to play in championing the impact and the possibility that entrepreneurship brings. Thank you.
Dean Jenga from Nairobi. Thinking about what this gentleman has just said, I've been in the teaching industry for 23 years. And I'm also an entrepreneur, and what takes me to entrepreneurship, especially social impact entrepreneurship, is the fact that I found most of the things I was teaching in class were not put into practice, especially entrepreneurship. So I decided probably the problem is mine. Let me go out there and be an entrepreneur. Cut a long story short, I think that you have to think of education institutions in a very special way. This is coming from where I am. We have just entered an agreement with the government of Kenya to support, as a business school entrepreneurship program, the regional development authorities, which have as their mandate to develop small and medium enterprises, entrepreneurs at the regional level. What does that mean? That basically means that we are going to spin off projects of the government, get funding for investors who are interested in social impact investing, and then roll out the skills that we learn and the experiences we learn from that to the smaller, medium, and small enterprises. And hopefully we will generate an entrepreneurial spirit in the poor sectors of the country of Kenya. Well, when I say that we are going into this regional development association, I don't think in your minds you have the quantities I'm thinking about. I'm talking about approximately 400,000 hectares of land. I'm talking about approximately 150,000 people to be affected by this project. And I'm talking about returns possibly at the range of 12% to 20%. And we are really interested in being an institution, a business institution that follows up the entrepreneurs, make them react to new technologies, make them understand what to do a business is, make them to know what continuity is, and then to get the supporting social impact investors to fund these projects or to collaborate in funding these projects. So comes my little problem for you. What do you find? You find social impact investors of all kinds. Most of them are vague. Let me put it this way. You go to an investment company and they tell you, I have a 3-year investment fund for which I want to make a return of between 25% and 15%. And I have to return that money within the next 4 years, or roll it over within the next 4 years. You go to some social investing companies and they tell you, I have a 5-year plan to invest this money. I think the key thing I'm trying to put across here is, if you want to go to social impact investing, number one, the only social impact investing that I know will have a quick hit on developing people is to work with government. They have the structures, they have the people, they have the policies, they have the culture, they have the politics. So think about it. Number two, do not go like Wendy and Nicola have spoken here, and I think also Sam has spoken here, with the ideas of risk parameters used in the common sense of business. You have to go with greater initiatives and ideas, and we need people to restructure the risk assessment of the social impact investing level. If you kindly want to go into this area, the paradigms must shift. The cultural setting of investment analysis has to shift. How do we do this? How do we do this? And this is the crucial thing, because we can't work without government in the social impact investing area. After all, they're the ones who have been in this business for donkey's years. Social impact, economic development.
Dean and Jenna, we all feel like you're a student now. Thank you so much for that, that intervention.
Hi there. My name is Roger Lucibeg. I'm representing African Co. My background is in academia, so a lot of my time was spent working with entrepreneurs in Africa. I'd like to respond to Sam's comments about having an investor view to incubation. One of the comments I also noted was that a lot of money goes towards growth capital, so investing in organizations that have already proven traction, have a client base, and typically in year 3 to 5. And if we're speaking about accelerating Africa's missing middle, or building Africa's missing middle, we're actually looking at 0 to 24, and not a lot of capital is going into that space. Another comment was also said that, well, often they don't have the capabilities, the business models aren't viable, the entrepreneurs are not, at a pace where they should be. How can we look at investment also in terms of investing into building the human capital of entrepreneurs as a form of pre-funding investments? And what role would investment companies play in that, and how would they collaborate with incubators? So again, we're looking at the bridge between incubators, who typically have an investor perspective, and who also typically take equity. Again, something that I'm not a big fan of incubators taking huge portions of equity in the entrepreneurs' ventures. So, there seems to be a gap in the space, and I'd like to know from impact investors how they're looking to address that gap and also connecting with the incubators.
My name is Max from Impact Amplifier. We do a lot of the packaging and incubation, pre-investment to impact investors. I think a couple comments. One, it's wonderful to see so many friends around here, colleagues, and just a wonderful social circle of amazing people. So I just wanted to acknowledge that. It's always great to have these events. Secondly, I think one comment is this forcing of social enterprises in South Africa to impact investors is just not going to happen. Because 95% in South Africa, impact investors will not be interested in. And there's probably a list, this long of reasons why not. And I think that's maybe an area of our development that we need to work on and shift and change. And connected to that is I think a lot of the deals are actually sitting in the traditional economy in sectors where there's embedded impact. But we need to start finding providers and service providers, intermediaries that can start funneling through that and digging very deeply into getting those deals out, understanding them, and taking them to impact investors. So my question is really, isn't the big gap that pre-investment packaging readiness, that we can find entrepreneurs and sectors, package them and take them to impact investors? Because I think if we can get over that gap, that cost gap, because there's a transactional cost to get them packaged and ready, there's a strategic cost, there's financial modeling, there's due diligence work that needs to be done. If we can get over that hump, I think we can close 20, 30 deals. And I think it's that cost hump that is prohibitive, because a lot of these intermediaries can take funding mandates and they can find success. It's just that first hump to get either the investor has to do it themselves or we need intermediaries. So it's that hump and trying to figure that out. Is that really where the issue is?
Matt, I'm going to exercise a bit of moderator's prerogative and add an additional dimension to this. So talking about accessing businesses that are engaged in the regular economy may not construe themselves as social enterprises, but are in areas that have specific social impact, and maybe are being managed to maximize that. That's one aspect. When we talk about the scale of impact investing that needs to happen, I still wonder, the broader commercial investing space has VC, has other kinds of products and instruments, all the way from structured debt to various kinds of other kinds of instruments that we don't talk about. We've been talking about impact investing for the last couple of hours. It's all been about small and medium-sized social ventures for the most part. Is there a whole other missing world, in addition to the point around targeting ventures that are in the mainstream economy and bringing them to the impact investor? I'll just plant that as a question, and Sam can.
Yeah, well, first of all, let me say I must agree with him. The last point, the point he made, which is, I think, where the gap is in the pre-investment phase. At least from where we sit, we see a lot of these opportunities, but we also feel there's a lot of work that needs to be done in that stage. And we are actually trying to focus more in that area of trying to create our own views in the impact investment space. I do feel if you look at mainstream, there's a lot of competition for businesses that are already at a scale where they're sufficiently attractive for the traditional private equity or the traditional commercial investor. It will be very difficult for the impact investing community to compete with the existing capital that is targeted at businesses that are in the mainstream. So I feel a lot of where, apart from finding businesses that have, that create social impact, a lot of where impact can be made in terms of capital is actually outside of, in my view, is outside of the mainstream. And just to touch again on, because I just listened to all the comments, I think they've been very, very useful comments. I was just making notes all through with a lot of ideas coming up. But just to touch on one question that I think came up, which was the issue around the worry that how do you then determine which businesses are actually impact investments as opposed to a business that, because almost every business, and we always have this argument, somebody comes to us with an opportunity and we say we are not doing it, but you can almost immediately justify, you can advise the guy to justify the social, to show the social element of that investment. The way we approach it, which is why I raised the issue around intent, is I always want to go back to the issue of intent of the guy who has the business in the first place. Because if the person is carrying out this business to generate a return, but also what he really has at the back of his mind is to address certain social issues, it becomes attractive for my impact investment portfolio. He might be generating a return and creating some social impact, but that may not be his intent. And the problem with that, and there's no problem with that from an investment point of view, but from an impact investment point of view, the problem with that is tomorrow down the line, the guy may need to make a trade-off between certain social things that that will create social impact and him just wanting some kind of additional financial return. And if you are not able to spot that, or to some extent, I mean, you may not. It's not a science. So you out of 10 you may get 3 wrong or 5 wrong or whatever. But I think it's very important to always engaging when you go through the due diligence and have interaction with the business person, to always try to find out what is really behind this guy's intent in doing this, so that it helps you in making that investment.
I've seen that we need to wind down. I guess the value of these kinds of conversations is that we get to witness each other's thinking and concerns, and that hopefully out of that we become much more intelligent. Hopefully we gather some wisdom about how to be more effective in what we're trying to do. the takeaway for me is that it shouldn't really be a buzzword. It shouldn't be the next buzzword if we do what Gary was proposing. I think that all the ingredients that are required for us to achieve this already exist, and what's missing is that we're not collaborating. So the challenge, I think, for perhaps the business school and the Rockefeller Foundation and Tony and Mia is ready to look at how can we create some kind of an ecosystem that makes it possible for us to collaborate effectively so that we leverage and our reach and our impact and the multiplier effect is possible.
And maybe just to reinforce a point, James, I think you were pointing to that. In doing that, I think in the collaboration, I think we need to think there's such a big overlap. When we look at Africa and the next 20 years in Africa, between what we're calling social issues and the development of the market. When we talk about 300 million Chinese people coming out of poverty, we don't think of them as a cost. Everybody now thinks of them as an opportunity, right? So I think that just trying to reframe some of our thinking and getting our venture capital thinking hats on, and the people that built railroads, they had a very different idea of risk. And there are lots of capitalists and lots of investors and lots of business people who have very different definitions of risk. And the more we have homegrown ones and people whose idea of risk is just at home, as opposed to somewhere far away, where they're comparing that risk to something else. Again, you look at Indian entrepreneurs who just deal with India's problems. It's kind of like, it's just business. And it's the risks are part of business, so I just think that trying to bring these worlds together more is such a big challenge in that collaboration process, because as long as we see the market and the social need, in the end, the people we're talking about are the same people, actually. The social need of the person whose child needs an education, who needs a job, who's trying to be an entrepreneur and hasn't got a health system to use, and it's all the same. There's a very big overlap here. So I just want to stress that, and I think that business schools and forums like this are very powerful because they bring people who don't normally talk to each other together. But how we structure that constructively is a challenge.
We can figure that out as we break bread together over lunch. So hopefully everyone here has a question that hasn't been fully answered or a conversation they would like to continue. I'd like to, first of all, thank you all for being a fantastic and engaged audience. And most of all, I wanted to thank the three panelists here. I've learned a lot just listening to them. I'm glad I came as fresh as everyone else is. And thank you all for dedicating time and insight to this discussion. So enjoy lunch.
Thank you.